All right, guys, I'm sorry. I'm late. Honestly, drama at the jiu-jitsu class today, man. It's a long story. I'll tell you guys in a second. Let me get everything up. That's why I'm late. I wasn't going to stay as long as I did today. I was going to leave a little bit early. But like I said, kind of a long story. Yeah, so we got Powell speaking today. Honestly, Tesla down. Market's kind of flat leading into it. SPY slightly up some, like a small amount. We are here. What a mess, though, dude. Honestly, again, a long freaking story. Sorry, I'm clicking stuff right now. So it might seem a little loud, but... Oof. Sorry, the clicking noise will go away in a second. There we go. We got Chicago PMI. No, so listen. So this is what happened today, bro. I'm just getting... I haven't even showered. Like, look at me. Right? Like, I'm literally just getting back. So I'm rolling with a purple belt today, right? And it's even worse because, like, his daughter comes to class, right? So his daughter is, like, a blue belt, I think, and, like, they both roll together and everything's all fine. Whatever. I'm rolling with this purple belt, okay? Granted, a purple belt's supposed to have, like, 5 years of experience, and he's okay. He's got good defense. I'm not here to talk bad about him. He's all right. He's pretty good. He's a little bit shorter, you know, so, like, size can... Anyways, I get him in a fully locked-in bow and arrow choke. Like, a fully locked in, like, legs over the shoulder bow and arrow choke. And he doesn't tap. And so I'm sitting there thinking, man, he's just got good defense. I'm sitting there thinking maybe he's got his hand around it like this and he's blocking it. And so I'm kind of like, ugh. And then immediately I start to hear snoring. And so I say, oh no. And I let him go. And he starts like, ugh. It's just, you know, I pick his legs up and I start shaking him and like he wakes up. But man, he should have tapped. It's the first time I've ever done that to somebody. He should have tapped, realistically. Bow and arrow chokes, there's no, like, if it's locked in, like, you ain't getting out, you know. No, he should have tapped 100%. I feel bad. Yeah, I do definitely need a haircut. I'll put a timer up. But I wasn't going to stay. Like, he was nice about it. He knew. He's a good dude, you know. And honestly, his daughter trains. His daughter's really good as well. They're both really good, you know. And it happens. The only choke I've ever gone out to was a bow and arrow choke, right? Because bow and arrow chokes are just different. It's hard to explain to somebody who hasn't been in them. They're just different. All right, so we got about 38.5 minutes, 37.5 minutes. Actually, it's at 55, so we actually got a little bit less than that. My mistake. It is, we have, it's until 55, so. Yeah, we got 52.5 minutes left. Again, Tesla going down. There's the timer. Powell is supposed to be talking the economy. So he's supposed to be talking the economy. The big thing to understand is this is Powell's plan per the last FOMC meeting. Powell's plan from the last FOMC meeting is 50 basis points last Wednesday, 25 basis points next meeting in November, and then another 25 in December. This will equal 1 full percentage points on the federal funds rate going down, right? So again, these are short-term interest rates, and they influence interest rates all across the country. There's a 3 to 6 month or sometimes longer lag that these happen. So like the Federal Reserve will influence rates if they want to increase spending, save the economy, you know, stimulate like a thriving economy. They'll lower interest rates, and then eventually the short-term rates will trickle into like mortgages or auto loans and stuff like that. And so when we say basis points, we're talking about we're talking about decimals of a percent. Right. So 100 basis points is a full percent. 25 basis points is a 1/4%. 50 basis points is 0.5%. The last Wednesday Fed meeting Jerome Powell cut rates by 0.5%, 50 basis points. And so what we're going to listen to today in Powell's speech is what he says about interest rate decisions moving forward, not only for the rest of this year, but what we're going to do next year. Because if the Federal Reserve is really aggressive in their rate cuts, then what's going to happen is, what could happen, at least I'm not going to say it's what's going to happen. What could happen is that we see a lower interest rate environment leading into next summer's real estate market. Typically residential real estate heats up during the summer. And if we have lower rates by that point in time, maybe it sparks a thriving, buyer's market or seller's market, I guess I should say. And again, we'll see. Let me know if you think that's going to happen or not. What do you guys think we're going to do? What do you guys think we're going to do in November and December? I don't know. Right now, if we look at the probabilities here for everything. So like right now, if we look at the probabilities, currently about 60% chance, 58% chance that we're going to cut 25 basis points. So another 0.25% next meeting in November. About a 40% chance that we're going to cut 50 basis points, another 0.5% next meeting in November. So we got another meeting in November and then another meeting in December. Oh yeah, you're right. This timer is way off, isn't it? Wait. Yeah, sorry. I did it too long. I don't know what I'm thinking here. We've got 30 minutes left. You're correct. This timer's wrong. There we go. That is correct. Sorry. Yeah, we're going to stream the entire thing live right here. So we'll stream the entire thing live. Again, forgive me. I'm looking rough. I just got back from jiu-jitsu. I'm all sweaty and kind of gross. I'm sorry. I can't help it. I don't have time, Yeah, we're going to stream the whole thing live. Don't worry. Cut rates equal more money flows into the stock market equals up. Sure, but there's also more inflation problems. So like the more we cut rates, the more we stimulate the economy. It's not like it's zero cost to it. Like if we cut rates and stimulate the economy, the consequence is going to be at least a little bit of inflation increasing. I mean, that's just supply and demand in business. And when people spend money, prices go up because businesses raise prices when people spend money. And so kind of we're in this situation in which, inflation is somewhat under control, but it's not necessarily good. We're at 3%. The real problem is that prices have gone up so much in 5 years, regardless of what the current increasing rate is. Prices have gone up so much that we don't want them to go up more. I think there's risks in raising rates or in cutting interest rates down. If it was up to me, to be honest, I would let prices genuinely stabilize, even if that means that we go into a little mini recession. Because I think that the real reason most people in the world right now, in the country at least, are unhappy is because of inflation. Stuff's too expensive now. It's hard to live. People are living paycheck to paycheck right now. And, for whatever reason, a lot of people are convinced that lowering interest rates is going to somehow make that better. It's not. It's going to make it worse, right? I understand now what cutting rates is going to do is it's going to help people who want to buy a house. It might help in fix rent prices. And so in terms of rent prices, it might help that stabilize a little bit more. The conventional appeal of real estate is that you can mortgage a home and pay less than you would in rent. And right now, at least with the high interest rate environment we've seen over the past 3-4 years, right now it's not necessarily like that. You're going to spend more money renting, or you're going to spend much more money getting a mortgage right now than you would in, renting a home, just because interest rates are so freaking high. But again, I understand both sides, and I think a balanced plan for a pivot into rate cuts. Basically, I think 25 basis points should be what we do November and December if we're going to cut more rates. Now, that doesn't necessarily mean it's going to be like that. It depends on what, number one, inflation data shows, payroll data shows. If payroll numbers are weak, there's a bigger chance that we're going to cut rates. If payroll numbers are strong, there's a greater chance that we're going to cut rates less. So instead of, if payroll numbers are weak, the logic is going to be, hey, the economy's weak, payroll numbers are weak, let's cut rates more aggressively in November, i.e. 50 basis points. If payroll numbers this Friday are strong and the economy looks good, the risks move on closer to inflation risks more so than recessionary risks. And so in that situation, I think the Fed would choose to cut rates 25 basis points and argue that, hopefully at least, that the economy's doing okay, payroll numbers are good, unemployment's low, so we don't need to cut rates as aggressively as some people want us to. So I think it's definitely nuanced. But yeah, we'll see what happens. So CME Watch Tool shows greater odds of a 50 basis point cut in December. Well, it depends on how you read this, right? So here's the CME Watch Tool. So if we do another 25 basis point cut, and that means after we're going to be at 450 to 475, and then from 450 to 475. Yeah, so this is another 25 basis. It is showing a 50 basis point cut. Yeah, you're right. I don't know. Again, what Powell said, that's why today's Powell speech is important, because we have to gauge what their plan is for the rest of this year. He speaks at 12:55 or 1:55 market time. Unless we reduce our spending, tough to bring inflation down. Yeah, for sure. One of the big reasons we had that much inflation is because of the stimulus packages, as well as the stimulus checks, as well as quantitative easing, which is basically the Fed creating bank reserves, printing money, and then using that bank reserve printed money to buy up financial assets like bonds, injecting liquidity, and ultimately helping keep interest rates low. That's one of the reasons. But again, there's a lot of reasons. All of it contributed to more spending, with a big specification on stimulus checks. That definitely contributed to it. And people wasted it. A lot of people burnt money. You give a bunch of teenagers a free couple $1,000s, they're going to buy dumb stuff with it. That's just normal. Human nature. I think it would change after today's speech, though, back to 50, 25, 25. Maybe. I hope so. I'd rather 50, 25, 25. We did 50 on Wednesday. Let's do 25 in November, 25 in December. That's what I would prefer, to be honest, but, All right. Steve Jobs was awesome. Thank you for your common sense explanations. Don't try to put Rampage Jackson in a triangle choke. Oh, I'm not. Honestly, a triangle choke is mostly meant for sport jiu-jitsu. Any like a Ezekiel choke, triangle choke, like those are chokes that you like only meant for really sport jiu-jitsu. I'm not saying they could never work. Like you can get somebody in one, but it depends on who you're fighting, Again, I kind of feel bad. I'm not gonna say who it was, but like he should have tapped, And he knew it, and nobody was mad at me afterwards, which is good, That's the immediate thing. I'm like, hey, I hope I'm not being too rough. Like I let it go as soon as I heard him snoring. I let it go, and he was fine. But Yeah, I'm not mad at you. I'm just disappointed in Nvidia. Where's Nvidia at right now? Is it up a little bit today? Yeah, Nvidia filled the gap back up to 120s. 120 seems like a pretty big milestone level for Nvidia. I'll put this up. Yeah, so Powell speaks on the economy. And potential interest rate decisions. Around 2 p.m. Eastern Standard Time. And this will be live streamed here. Yep. There you go. We're gonna full. Yeah, no, I know exactly the reference. That's a very famous slam. It's not really gonna work on most people though, but it depends on what you're. Yeah, it just depends. What hour do you perform best? I probably perform best about 15 minutes after the opening bell. What does that mean, Pawn? All right. Tesla in a downward trend. Look at the really obvious downward trend. I can't even, look at this. Honestly, if I could buy a Tesla and actually get a, like, tax-wise, find some way to write it off, I would. But to be honest, I just can't. I don't have a justification for it, right? Like, most of my businesses are online. I guess I could have it for marketing purposes if I slapped a big old banner of some sort about my business around. But I don't know. I don't know if I'd want people to see it anyway. Like, oh, Sandman puts people to sleep. Oh, I see. I got it. That's the only person. Listen, again, the bow and arrow choke is different. Okay, the only time I've ever gone out in jiu-jitsu is specifically when a very specific thing. I was my professor's Yuki is what it's called. I was his dummy, basically. I was his assistant. Think of like a magician's assistant. I was his jiu-jitsu assistant. And so anyways, he was showing the class a bow and arrow choke. And it was the first time I had ever been put in a bow and arrow choke, right? And it's a blood choke. So you can breathe fine and then it's done, And so I get put in this choke and then I feel like I tapped, but it was too late. And I ended up waking up about 15 seconds later. I ended up hearing like reggae music in my head, like drums, like do 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 do. And I was like kind of having like a little party in my head. I remember this. And then I woke up like 10, 15 seconds later. Apparently I was snoring with my eyes open and everybody's freaked out staring at me in class, And I started laughing about it afterwards because, but everybody else was apparently freaked out. And I guess I could understand why after today, Anyways, I'm going to get back to stocks. Yeah, so Nvidia up there. We're going to look at the NASDAQ. I'm going to put gold up. And this dude's a good dude. Like, he was there with his daughter. They both trained. Like, they're just, he just should have tapped. He was a good guy. Y'all are like my therapist, All 900 of you guys. All right, guys, we got 15, 17 minutes left. Let me do a poll. Please. Yeah, drama at the... Yeah, so let me do a poll. Here, I got it. So, will Powell have a hawkish or dovish tone today during his speech? Again, just to put this into perspective, hawkish means restrictive monetary policy. Restrictive policy. Dovish means less restrictive policy. Will Powell have a hawkish or dovish tone today during his speech? Vote on the poll. Let me know what you guys think. Is gold going to anchor after Powell? I don't know. Is S&P 500 buy or sell? I don't know. It depends on what Powell says. No, I don't have a crystal ball. Nobody does. Anybody telling you that's just kind of making up stuff. Whew. Thank you, sir. Powell to get hawkish. So again, hawkish means he wants I think he's going to have a hawkish tone because we already cut rates 50 basis points, and so he tries to be balanced. And so I think he's going to be hawkish, but also he's going to still cut rates, right? So I think he tries to be balanced. So like generally, if he's restrictive in terms of decisions, he will have a dovish tone. If he is restrictive, if he is less restrictive and dovish in terms of decisions, he'll have a hawkish tone. That's my guess. And since we cut rates 50 basis points, and for a while people thought we might do 25, then I think he's going to have a restrictive tone. I think he's going to be balanced, is my guess. I might be wildly wrong, and I don't know how the market's going to respond to either of them, but that's my guess. Yeah, you don't have to owe them $50K. That's not how it works. It's just $49. Yeah, all you lose if you lose the challenge is the monthly subscription. Wow, that's it. Whatever he says changes nothing. Big money will move the markets one way or the other, and 80% of you will get liquidated. Good luck, though. I mean, yeah, that's probably pretty accurate, you know. I mean, big money's going to do what big money does, but the thing about it is that big money bases their decisions a lot of the time around Fed decisions, and so, you know, I mean, we could say this is insignificant, but of course, there's a reason we got 1,000 people here, and you know, when he speaks, we'll probably have over that. We'll probably have at least a couple thousand here when he actually goes live. And so, yeah, I mean, it's important. Big money watches this. Big money understands the implications of this, meaning big money benefits when interest rates are low. You know why? Because everybody has cheaper access to money. You know, so like when interest rates are low, people can get loans for less. They take out loans more. They refinance more. They have money, so they spend it. Ultimately, the economy and business thrive whenever interest rates are low. And so you better believe they're going to be paying attention to the decision on making interest rates low and what Powell's plan is moving forward for the rest of the year in terms of interest rates. Like, they're going to be watching it. And so Big Money specifically watches the stream. Definitely the top 3 most watched Big Money streams in the world right now, I think. The Spy at 571s. Can I buy your course? What kind of course? John's Tomato Plants for Beginners? You know, dude, I don't have a course. It's all free. Not a paid course, at least. We got some free courses on YouTube. Go check them out. This is his course. That's right. Listen, I'm here. All right, guys. Hey, we got 12 minutes. Whew. Forex trading. I don't even trade Forex, bro. It's like asking Benjamin Franklin if you can buy his pilot's course. Like, dude, it doesn't make any sense. Where's a stream? Right here. Is this an FOMC backed speech or just his point of view? I mean, I don't know. It depends on what you define as that. So today's speech is specifically about Hold on. It is specifically about economic outlook at the National Association for Business Economics annual meeting in Nashville, Tennessee. So it's you probably want to pay attention to it. You know, we already got some people speaking about it right now. You know,
standing to be recognized, please.
But Powell is going to speak in about 10 minutes. So nobody really important speaking right now. No offense to them. I mean, I'm not saying they're not important, but regarding this live stream, you know. Yeah. I can predict the future, John. Stop lying to them. I have a crystal ball. You might have crystal, but you don't have a crystal ball, bro. Got him. Anyways, gold. Where's gold at? I don't know. All right, we're at 2,700. Do you have own Bitcoins? Like multiple Bitcoins? No. Do I own multiple Bitcoins? No. That's a lot. That's basically asking me if I've got, 130 grand in Bitcoin, and no, I do not. I've got a little bit. Do you affiliate with the political side? Are you going to trade this speech? We'll probably trade the consequence of this speech. It'll be a neutral tone. He obviously knows his words hold weight, trading the after effect. Yeah, for sure. I agree. The speech is going to be right here, Mar. We're going to stream it live right here. So if you want to watch it, stick around. All right. Copper's crazy this session. Yeah. Gold's at 2660s. Also, guys, if you haven't already, check out Top Step. So we're going to be trading on Top Step. They're my one sponsor. We only got one sponsor right now. And Top Step's really nice because Top Step, ultimately, it's like a test of skill in the beginning of your day trading. If you can't pass this test, you probably shouldn't risk thousands of dollars of your own money trying to day trade. If you can pass this test, there's benefits. Ultimately, your risk is much less than putting up thousands and risking thousands yourself. What Top Step does is they give you a demo, and they test your skill with the demo account first. If you pass the test, they fund you. If you fail the test, you only lose the monthly subscription. The base one is only $49. They give you a $50K demo account. If you can make $3K in profit on that $50K demo without losing $2K first and following their rules and conditions, confirm everything with them. They're an affiliate of mine. I'm biased. They pay me money. But if you can pass that test, you get $50K in funding, and they've paid out over $40 million to their traders. They fund thousands of traders. They have some of the best rules in the game in funding. There's a lot of funding programs. Top Step has some of the best, in my opinion, the best edge in funding right now is on Top Step X. It's genuinely the best edge because there's no commission. You can trade micro contracts with no commission on Top Step X, a powerful edge. And again, once you're funded, it has some of the best rules in the game. If you want to check it out, here's the link. Again, they're an affiliate of mine. They pay me money. I am biased because they pay me money. But you can check it out right there. Great way to help support the channel. I appreciate it. We're still waiting on Powell to speak. He's got about 7 minutes left. 7 minutes left. He speaks at 1:55. We're going to stream it all live right here. Stick around. Yeah, we don't know what's going to come out of Powell's mouth 100%. Nobody knows. Tread lightly. Trade small. Trade safe. You know, we're listening to some of these guys.
Thanks so much, Levon, for that. And I can attest to that. I mean, the longer you're a NABE, the more you donate, eventually your name tag starts to look like a CVS receipt, right? So it gets very, very long, but...
Should I donate to NABE? You know? Again, so Powell speaking today. Again, we're going to cover Powell specifically. And he's supposed to speak regarding the economy. I don't know who this is, this old guy.
Business economics. First, we'll begin with the Abramson Awards for the best papers published in business economics.
Okay. Yeah, we're going to share the speech. Powell's not speaking yet. He speaks at, again, 1:55 in about 6 minutes. So we're going to cover it. Don't worry. We got it. I'm going to put it in sub-only mode. Hit the subscribe button. Do it now. Try it one time. It might feel good. Everybody's doing it. You know, subscribe now. Eastern time. 1:55 Eastern time is in about 5 minutes. A little bit less than that. Employment and employee income. So yeah, we do have payroll numbers on Friday. And again, if it's your first time tuning in, we cover everything live right here. We cover every major economic report, Powell meeting, speech, CPI, PPI, jobless claims, retail sales, unemployment, non-farm payrolls, PMI data. We cover all that stuff completely live every single day right here. And again, if you want a place that covers it live every day, we do it. And so stick around, hit the subscribe button. It's definitely helpful. How can I contact you? I mean, listen, bro, if you want me to be your mentor, I can't. Listen, dude, I'm not even claiming to be a good trader, bro. You know, like I'm covering economics, you know, asking me how to be a professional day trader. I mean, listen, I'm not saying I'm bad at day trading, but I definitely don't have time to be anybody's mentor. You know, you can watch the stream, you know. I appreciate it. It's all love here. I appreciate the love. I try to report everything for free and give people like a free option. But with that said, my time is limited. And so I hope you understand. Buy gold? I don't know. Gold, again, I've said this 1,000 times. But gold, you know, gold has some good and bad things about it. Number one, long term, meaning like 20 years plus, gold is very consistent. It's going to go up. Almost certainly. Right? The problem with gold is that while it can uptrend for a long time, it can also downtrend for a long time. And gold has been uptrending now since 2020. Really, it's before that. Gold has really been uptrending long term since 2018, 2019, 2017, 2016. So for almost a decade now, gold has been on one of its big runs. For almost a decade. Here's gold starting off in about... Again, gold 10 years ago was right here, and gold has done this in 10 years. Right? So gold has gone up basically 100% in 10 years. Okay? The problem, though, is that gold also can downtrend for an extended period of time. And so as you can see here from 1980 all the way to 2000, gold can downtrend for decades. And so I guess the point is, if you're going to buy gold, it needs to be like a long-term investment. Because if you try to buy it for some type of short-term thing, it can downtrend for a decade on you, you know? So, like, I guess the point is gold's good. It goes up. It's actually outperformed the S&P over the past 20, 25 years. But it can also downtrend for a decade. And so unless you have time to let your investment work for you, you know, there's pros and cons, I guess is the easiest way to put it. Just use the link. You'll get the discount, Arian. Well, yeah, I mean, we could always isolate a time frame, Dar, but, you know, depends on how you look at it. Stock market's obviously one of the best long-term edges you can get, and so, you know. All right, chat. We got 2 minutes left.
Conference planning committee.
Okay, I'm going to swap out my headphones. I do need to do that real quick. All right, so just to clarify, can y'all hear the music right now? Just want to make sure you can hear it. I'm also going to put some of this down, get the speech ready. We got gold up here. Really doesn't make sense. I'll just put those two up. We got Nvidia, the Q. Again, Powell's about to speak. put like the NASDAQ up here on the top, or maybe like Bitcoin or something. Everybody's asking me about Bitcoin. There we go. And then
and the Economist Intelligence Unit. So thank you all. Thank you to all of you. I'd also like to thank the Federal Reserve Bank of Atlanta for its support of the conference and for hosting a fantastic reception last night. Probably a little too fantastic, but really, really good. A great time. It's so important that we, as business economists, communicate with our Fed colleagues, and events like these go a long way to reinforce these ties.
So we're waiting here,
and then
chat.
to have it at the Johnny Cash Museum was really, really special. So thank you. A shout out to the CFA Society of
Sound
Nashville,
check. Can you guys hear
our
this?
regional partner, and a special thank you to the recent CFA president, Ann Taylor Knotts, who served on our conference
sound check.
planning committee.
1 2 1 2. Can you hear this?
And to Angie Brown, the executive director of the Nashville CFAs, who organized tonight's reception. And now, the openers are done. With no further ado, I'm really delighted to welcome our president, NABE President Ellen Zentner, to the stage to introduce Chair Powell. Thank you very much.
All right, here we go. Y'all can hear? All right, good.
That's Madam President.
Let me turn the music off.
Okay, so oh no, I already lost my mic. I'll fix that. Okay. So I have the pleasure over the past year of serving as president of NABE, of meeting even more new people than I normally have met. And I've been a member of NABE since 1998. And to cap it all off, I get to close out my presidency this year by hosting and moderating Jerome Powell, which is such an honor. And he's been so generous with his time for NABE. So Jerome Powell was appointed to the Board of Governors in 2012. I'm going to make this very short because if you don't know Jerome Powell, then I'm not sure why you're here. And he was reappointed in 2014. In 2018, he became the chair of the Board of Governors and was sworn in for a second term. He's had a long career in finance, and he's no stranger to navigating financial crisis, both at Treasury and while on the Board of Governors. Chair Powell will provide some prepared remarks, and then I'm going to invite him to join me on the stage for a moderated conversation. So Chair Powell, please, the floor is yours.
All right, here we go. Here we go, guys. Hit the live button. Make sure you're fully caught up on stream. Let's see what Powell says today.
Thank you very much, Madam President. I do have some brief comments on the economy and monetary policy, and then I look forward to our discussion. Our economy is strong overall and has made significant progress over the past 2 years toward achieving our dual mandate goals of maximum employment and stable prices. Labor market conditions are solid, having cooled from their previously overheated state. Inflation has eased, and my Fomc colleagues and I have greater confidence that it is on a sustainable path back to 2%. At our meeting earlier this month, we reduced the level of policy restraint by lowering the target range for the federal funds rate by a half percentage point. That decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in an environment of moderate economic growth and inflation moving sustainably down to our objective. Turning to the labor market briefly, many indicators show that the labor market is solid. To mention just a few, the unemployment rate is well within the range of estimates of its natural rate. Layoffs are low. The labor force participation rate of prime age workers is near its historic high, and the prime age women's participation rate has continued to reach new all-time highs. Real wages are increasing at a solid pace, broadly in line with gains in productivity. The ratio of job openings to unemployed workers has moved down steadily but remains just above 1, so that there are still more open positions than there are people seeking work. Prior to 2019, that was rarely the case. Still, labor markets have clearly cooled over the past year. Workers now view jobs as somewhat less available than they were in 2019. The moderation in job growth and the increase in labor supply have led the unemployment rate to increase to 4.2%, still low by historical standards. We do not believe that we need to see further cooling in labor market conditions to achieve 2% inflation. Turning then to inflation, over the most recent 12 months, headline and core inflation were 2.2% and 2.7% respectively. Disinflation has been broad-based, and recent data indicate further progress toward a sustained return to 2%. Core goods prices have fallen 0.5% over the past year, close to their pre-pandemic pace, as supply bottlenecks have eased. Outside of housing services, core services inflation is also close to its pre-pandemic pace. Housing services inflation continues to decline, but sluggishly. The growth rate in rents charged to new tenants remains low. As long as that remains the case, housing services inflation will continue to decline. Broader economic conditions also set the table for further disinflation. The labor market is now roughly in balance. Longer-run inflation expectations remain well anchored. Turning to monetary policy. Over the past year, we have continued to see solid growth and healthy gains in the labor force and in productivity. Our goal all along has been to restore price stability without the kind of painful rise in unemployment that has frequently accompanied efforts to bring down high inflation. That would be a highly desirable result for the communities, families, and businesses we serve. While that task is not complete, we have made a good deal of progress toward that outcome. For much of the past 3 years, inflation ran well above our goal, and the labor market was extremely tight. Appropriately, our focus was on bringing down inflation. By keeping monetary policy restrictive, we helped restore the balance between overall supply and demand in the economy. That patient approach has paid dividends. Inflation is now much closer to our 2% objective. Today, we see the risks to achieving our employment and inflation goals as roughly in balance. Our policy rate had been at a 2-decade high since the July 2023 meeting. At the time of that meeting, core inflation was 4.2%, well above our target, and unemployment was 3.5%, near a 50-year low. In the 14 months since the July 2023 meeting, inflation has moved down and unemployment has moved up, in both cases significantly. It was time for a recalibration of our policy stance to reflect progress toward our goals, as well as the changed balance of risks. As I mentioned, our decision to reduce our policy rate by 50 basis points reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate economic growth and inflation moving down sustainably to 2%. Looking forward, if the economy evolves broadly as expected, policy will move over time toward a more neutral stance. But we are not on any preset course. The risks are two-sided, and we will continue to make our decisions meeting by meeting. As we consider additional policy adjustments, we will carefully assess incoming data, the evolving outlook, and the balance of risks. Overall, the economy is in solid shape. We intend to use our tools to keep it there. We remain resolute in our commitment to our maximum employment and price stability mandates, and everything we do is in service to our public mission. With that, thank you very much, and I look forward to our conversation. Thank you.
All right, so let's see what the convo has. The market hasn't really moved. It's up slightly since he said this.
Thank you so much.
Let's see if they fix the
Short
camera.
and sweet.
Yeah.
So here we are in Tennessee. We've had a major hurricane move through. It's top of mind. You know, when so I thought to bring it up right at the beginning. Does the Fed have a role to play when natural disaster strikes?
So let me just say, like everyone, we see the tragic loss of life and the terrible disruption of millions, literally millions of people, including here in Tennessee. We have a couple of things that we do in these situations. One is that we're encouraging bankers to work with their affected customers in affected areas. And the second thing is that sometimes in these situations when power is out, there's a need for cash. And so we find that as a very important thing in these disaster situations. And so we have the ability through the reserve banks to make sure that the banks have available cash so that if power is out for a significant amount of time, there's enough cash to do transactions. But obviously we're mainly on the sidelines and sympathizing with this very difficult situation people are in.
Great. You, in your prepared remarks, you walked us through the decision to begin cutting rates. What has happened, though, since the September meeting? What's new since the September meeting?
Since the September meeting, so most of the data that we'll see before our next meeting hasn't come yet, of course, and we can talk about that. But I would say, one thing worth pointing to is the annual NIPA revisions, which I thought were quite interesting, and I'd point out a couple things. First, as this audience will know well, there are two ways of measuring output in the economy. There are many ways, but two principal ways are gross domestic income versus gross domestic product, so GDI versus GDP. There's lore and there's research that says that actually GDI, gross domestic income, gives a better real-time reading. And for the last year and a half or so, GDI has been quite low relative to GDP, raising, for those of us who forecast the economy, the risk that that GDP will turn out to have been overstated and it'll get revised down to meet GDI. So that's been a downside risk that we've been monitoring. As this audience will well know, quite the opposite happened, and there were very large adjustments to revisions to GDI, and there's now no gap between the two. In theory, there should be no gap. It's no statistical error in measurement. So that kind of, I would say, removes a downside risk to the economy. Secondly, it has looked as though consumers were spending more than their income. We see disposable personal income now being estimated up, and so that's no longer the case. Again, removing what we've been thinking of as a possible downside risk that the level of consumer spending might be unsustainable. So we look at that, and again, it looks, these were very large, healthy upward revisions to income. And
so we had income was revised upward, spending was revised upward, but income was revised upward so much more so than spending that the savings rate came up.
That's right.
Even with greater spending.
Yeah, the savings rate too. So we think savings are now, there are more savings on people's balance sheet and the savings rate is higher. So that speaks of more kind of background that suggests that spending can continue at a healthy level. I'll just mention quickly two other things that I thought were interesting. One was just another modest increase in estimated productivity. We can talk more about that, but of course we're watching the situation with productivity. Productivity is very important to potential output, and the question is, are we seeing rising productivity which will be sustained over a period of time? And of course, I think it's way too early to say that. Nonetheless, you do see some increase in productivity because we've increased income, but not hours worked. The last thing, and maybe the most significant though, is there's a bit of a tension between the labor market data, which speaks of a cooling labor market, and the spending data, the GDP data, and which has been quite solid. And I would say that tension has not been resolved, unlike a couple of the others. Nonetheless, I would say though that if you take away from this, as I do, that you can be somewhat more comfortable with the spending data. That may also help with the employment data.
So if the economy, so GDI, it was pretty significant upward revisions. GDP also was revised upward somewhat. And so when there's strength in the economy like that, does that give you some sort of sense or more of a sense of security when you're seeing a cooling labor market that maybe the worst outcomes won't happen if GDP is still that strong?
So the answer is ultimately yes, but I would add though that I think there's a lot of thinking that the labor market may give a better real-time picture in some cases than does GDP data. So if you look back over prior downturns, you'll often see that they weren't well predicted by GDP data, but they were by one or more aspects of the labor market. Now, we don't see that happening. There's really nothing that I can point to in the economy that suggests that a downturn is more likely than it is at any time. So we don't see that, but I would say seeing that there's more support for thinking that the GDP readings we get are solid, I think that does have, it helps at the margin. That's not going to stop us from looking very carefully at the labor market data, though.
Okay. So I have a few questions here on unemployment. The first is related to the summary of economic projections, and then the second is related to state versus national rates of unemployment. So in the summary of economic projections, the median participant has the unemployment rate moving from 4.2% today to 4.4% by the end of the year. So continued drift upward. And yet the median expects that the pace of rate cuts will move down as the unemployment rate continues to move up. How do you square that picture? How do you explain that?
Well, remember that the summary of economic projections is really just a tabulation of the individual 19 participants. So it doesn't come from one sort of consistent thing. But I can tell you why I think people will have written up a couple more tenths of unemployment. It would just be that, as we've seen, the level of job creation is maybe not quite at the level it needs to be to hold unemployment constant, given assumptions about supply. That would make sense to me. I think everyone at this point is looking at their forecasts and understanding that there are great uncertainty bands around it. But the SEP asks you to write down your most likely case, whether you want to or not. And so that's what it is.
So sort of a love-hate relationship with the summary of economic projections?
That's not unfair.
Not for you personally, but yeah. Is there
I would say it's sometimes people can pay too much attention to it. I will say, though, one thing is we do it, as this audience well knows, we do it once a quarter. And over the course of a full quarter, the old SEP can get pretty rusty, But for a few weeks after the meeting, after we write down the SEP, it's actually a pretty good read on what the thinking of the committee is. And one thing I will point to is that if you look at the path that people wrote down, we had 10 people at 4 cuts or more, or 2 remaining cuts. We had 19 people at 3 or more. But the sense of the committee, this is not a committee that feels like it's in a hurry to cut rates quickly. It's a committee that wants to be guided. Ultimately, we will be guided by the incoming data. And if the economy slows more than we expect, then we can cut faster. If it slows less than we expect, we can cut slower. And that's really what's going to decide it. But I think from a base case standpoint, we're looking at it as a process that will play out over some time, not something that we need to go fast on. It's more, it'll depend on the data, the speed at which we actually go.
Yeah, so before I get to that second question on the unemployment rate, I'm going to ask you a point blank question here. How are you thinking about the November meeting?
So a couple things. One, we have 2 employment reports and an inflation report coming in. So the main thing will be to look, when we get to that meeting, at the totality of the data, and we'll be looking at the activity data, the unemployment data, and the inflation data, and asking ourselves, is our policy stance in the place where it needs to be for us to best foster achievement of our goals? And I think we'll take everything into account, and we don't have that data yet. So that's the main thing. But the other thing is just, I wanted to point out, and I kind of just did, that it's a committee that we will do what it takes in terms of the speed with which we move. But if you look at where we were 2 weeks ago, coming up on 3 weeks ago, I guess, when we wrote down our SEPs and made our decision, it was a situation where people were thinking, the bulk of the committee was at 75 or 100 basis points, and the votes were on 50, and that would mean 2 more cuts. It wouldn't mean more 50s. Now, of course, that'll depend on the data, but ultimately that's what the baseline is. If the economy performs as expected, then that would mean 2 more cuts this year, a total of 50 more.
Okay. Question from the audience now. The regional bank presidents know their districts very well. and they come into the FOMC meeting, and well, even before that, the Beige Book, right, provides that snapshot of what's going on around the country. And so we focus on the national unemployment rate, but there are state unemployment rates as well. Are there certain states that are primarily responsible for driving up the unemployment rate nationally? Is it something that's more broad-based? And how would you weigh sort of national versus state level?
I mean, at the end of the day, we're looking at the national aggregate levels, but the real value, one of the great values of the Reserve Bank system is we get, detailed reports of what's happening in the districts, which really start with the directors of the branches and the main banks who come in and talk to they talk to the staff and also to the president of the Reserve Bank. And I think the banks just do a great job of gathering data and anecdotal information too about what's going on in the district. This is enormously useful to us who are sitting in the center and don't have that range of context or so I think it's quite useful. But at the end of the day, we have to go on national data. Although, of course, there are there are different things. It's a big country, a big economy. There are parts of the country that are, doing better than others.
In your prepared remarks, you mentioned about job finding prospects. We have Dana Peterson here, chief economist from the Conference Board. The Conference Board had data recently showing that folks feel like it's getting harder to find a job. Does that, one, concern you? And two, how do you weigh sort of survey data versus hard data like a job openings and labor turnover survey, for instance?
We look at everything, of course, but in particular, the job finding rate has come down very significantly. And so if you're out of work now, it's going to be harder to find a job than it was 2 years ago when the labor market was extremely tight, where you would have had multiple employers waiting for you outside the building to give you offers. Now it's much more at a normal level or even perhaps a little bit soft. So the job finding rate is much lower. So by so many measures, the labor market is still solid, but it really has cooled. I mentioned vacancies relative to actual unemployed people who are looking for jobs. So they're counted as unemployed. That is right around 1.1 ratio. That was a tight labor market before the pandemic. But it's less tight now. That number was at 2.0 and it's worked its way down. Like so many measures, quits, all of those wages, they point to the same thing, which is a labor market that's still strong, where conditions have cooled considerably. And as I mentioned, we don't think that labor market conditions need to cool further from where they are. Just to take the unemployment rate, it's substantially higher. 4.2% is substantially higher than where unemployment was in 2019. And inflation was below 2% 2019. Take a broad set of conditions, look at 2019. That was not a high inflation environment. So this is not a problem with excessively tight labor markets causing inflation.
I'm so glad that someone submitted a question on housing inflation. I'm sure you're so glad as well. And so I'm going to ask it because we haven't really talked about inflation yet. You made a great point in your prepared remarks that it's running right around, 3-month annualized pace is running right around 2%. So housing inflation has been a large contributor to the overall inflation and continues to be an issue throughout the country, eroding wage gains. And although housing costs are not a dual mandate, how is the housing market factored into decision-making by the Fed?
So, we think of core inflation as 3 buckets: goods inflation, non-housing services, which is by far the biggest bucket, and then housing services, and that's rents and also owner's equivalent rent. The first 2 have looked like they've, broadly speaking, moved back to their pre-pandemic level. Housing services inflation has not yet. And what's happened is that what should happen is when market rents drop, as leases turn over, when the increase in market rents drops to a low level as it has, as leases turn over year upon year, you should see housing services inflation flatten out. And you are seeing that, but you're seeing it just at a sluggish pace, as sluggish as it usually. So I think I went from thinking at the beginning that this would happen fairly quickly to now thinking that process will play out over a period of some years. 2, 3, 4 years. Nonetheless, as long as market rents, actual new leases as long as inflation in those rents, those leases, is relatively low, it's going to show up in housing services inflation as well. It's just going to take, my guess is it's just going to take longer than we've been expecting and longer than we've wanted. But I think, you know, the direction of travel is clear as long as market rents remain, market rate inflation remains relatively low, which it still does.
So the goods side of that equation, goods prices are less, you know, less under the control of the Fed, but we have been sort of moving back to our previous regime of deflation in goods prices. Some of that is probably sluggish growth from China, but how much do you rely on goods prices being in deflation in order to help that overall aggregate inflation
Well, so if you
number?
go back before the pandemic, you had, as you pointed out, you had mild deflation in goods for, you know, globalization reasons and other reasons. And, you know, so if you take those three buckets I talked about, together, they produced inflation between 1.7 and 2%. So we're trying to get back to a world where inflation is 2%. And the combination of those three buckets is less important than the fact that you get the aggregate back. So I just pointed out that goods inflation is kind of back to where it was, and so is non-housing services, and that's most of the inflation bucket. But the third one is not there. Any combination of those things will do, but I think it really looks like the third over time is going back down to where we would like it to be, which is at a level which won't be 2%. It'll be a little higher than 2%, but that will make the aggregate 2%, right in the range of 2%.
So you're going to be embarking on a review of the framework. And inflation, the behavior of inflation since the framework change in 2020, do you think that will inform, or how well will that inform the discussions when you do start the process of going through that 5-year review again?
So we're starting our second 5-year review late this year. So we haven't started yet. We're just now in the process of kind of laying out all the questions we're going to ask and assigning the memos and doing that kind of thing. We're not really ready to roll that out yet. But of course, you know, we're going to be asking how should we change our framework, which is embodied in the Statement on Longer Run Goals and Monetary Policy. How should we adapt that to what we now understand to be the way the economy works? What have we learned from the last 5 years? And that's what we'll be doing. So we'll be asking all of those questions and you know, giving our answer.
5 years has flown by. I can't believe we're already up on another review of the framework.
Can't believe it.
It feels like yesterday.
I know.
So let me ask you, because you talked a few times about the data that you're going to receive before the November meeting. And one of those data points, most notable being an employment report that comes out during blackout. Some time ago, the blackout period around Fed meetings was extended. And I can tell you that as a longtime Fed watcher, I loved it when the blackout period was extended because it was almost like a sleep while the baby sleeps. So I could like relax longer leading up to the meeting because we could all sort of take a break. And I also used to have a saying that and this was my personal saying, the Fed does not react well to late breaking news. And it was my way of saying, once you went into blackout, that was it. The data in hand determined that meeting. But it feels like more so over the last year or two, data, and maybe it's the volatility around the data is being considered during the blackout period. Maybe it always was, it just wasn't that volatile. But even policymakers have talked about and yourself, you know, data that was released during blackout leading up to the meeting. So what does that mean for an employment report that's released during blackout just ahead of the November meeting?
I mean, it depends on the broader situation, but if it's a really important employment report, you should assume we haven't made a decision until we see it. And we're absolutely going to take into account data, important data that comes in during the blackout period. It gets harder when it's like this, you know, the morning of the second day of the meeting. It's harder to do that. Yeah. But, you know, because, you know, everything, it's you know, it's a big machine. But if it comes out during the blackout period, you know, you should just, going into that, you should just assume that what happens there could really matter for the decision. If that makes sense, there might be a situation where that wouldn't make sense. But I think in the world we're in right now, then, we're going to be looking carefully at the data, even though it's in blackout. Absolutely.
And if this is right, then even during the deliberations, during the FOMC meeting, policymakers do have the ability to change their thinking or their forecasts or their views during that meeting.
Yes, I mean, we do a lot of work, during blackout. We spend a lot of time. I talk to every participant on the Thursday and Friday before the meeting in detail about the economy and what they're hearing. And so there's a lot of discussion that goes on. And ideally, what we discuss in the meeting is kind of a synthesis of all of the views and information that we're all sharing with each other. So, but you should just assume, though, that decisions don't get made until the meeting. They're not going to be made. I mean, sometimes there isn't really a decision to make, right? It's pretty obvious what we're going to do. Other times, when there is a serious decision to make, you should just assume that it gets made with as much information as possible. If you make the decision before you get all the information, you're throwing away, some information there. You wouldn't do that.
Yeah. So when you began hiking the federal funds rate in 2022, the focus has been on the policy lags, sort of long and variable, but who knows how long or how variable. And so, it seemed like the lags were longer than we thought they would be on the way up. Does that mean that the lags may be longer on the way down? And how do you gauge whether those lags are changing?
This is a very hard part of it. You can't really know, even now, we can't really know why what's happening is happening. People will be debating in 25 years whether what's happening now with the cooling labor market is due to policy lags or due to something else. So we can't know. What we can know is that what we believe is that policy works with long and variable lags, and we have to take that into account in our thinking, and we do. It's challenging. On the other hand, just take the current situation. What you see is solid growth in the economy. And what you see is a solid labor market. So in a way, the measures we're taking now are really due to the fact that our stance is due to be recalibrated, but at a time when the economy is in solid condition. That's what we're doing. We're recalibrating policy to maintain the strength in the economy, not because of weakness in the economy.
The transcripts are released every 5 years. And so I believe it's January of 2025 that we'll first get a look at the 2019 transcripts. And 5 years ago, you may recall that you were cutting rates. So give us a peek, if you will, into what the transcripts might show around the deliberations you were having at that time as to what were you seeing in the national and the international economy that would drive you to make that rate adjustment, and what did you see that made you feel like you had done enough?
It's a very different situation than the current one, I guess I'd start by saying. But so if you remember, we had raised rates very slowly, I think a total of 9 times to maybe 2.25% and 2.5%. And what my colleagues and I were feeling in 2019 was significant global economic weakness, and also some weakness in the United States economy, and also just a lot of, this was a time of a lot of trade issues, and it was markets were really uncomfortable, and business sentiment was very concerned. So we cut 3 times, and I felt like at the end of the year, I really felt like it had worked well to settle things down. And so we were still, at 175 basis points or something like that. That was that situation. Current situation is one where we raised really quickly to the highest level in 20 years, policy being at about 5.3%, 5.25% to 5.5%, to help with inflation in a world where we had the highest inflation in a long time. And then I think if you take a snapshot of our policy stance, which we put in place in July of 23, and look at, I did this in my remarks, unemployment was 3.5%, really tight, and inflation was 4.2 or 3%. So now look where we are. We're at 4.2% unemployment and 2.5%-ish in inflation. So the stance that we put in place 14 months ago is not the stance that we need now. It's time to recalibrate. And I think we held on for a long time. And I think we did the right thing. I mean, history will tell, but I think we wanted to get confident about inflation so we wouldn't be in a situation where inflation could just come right back. And so we held on long enough that I think we're more confident so this is quite a different situation than 19, but that's how I remember 19.
Do you think that the 50 basis points that you delivered in September, that cut you described as a strong start, did that cut give you more confidence in the soft landing?
I would put it this way. It's a reflection of our confidence that inflation is moving sustainably down, our growing confidence that it's moving sustainably down to 2%. As I mentioned, our design overall is to achieve disinflation down to 2% without the kind of painful increase in unemployment that has often come with disinflation processes. So that's been our goal all along. We've made progress toward it. We haven't completed that task. I think you'll see us using our tool, in a way that shows our commitment to achieving that. In terms of, I don't want to make a judgment about its likelihood. I just want you to know that we're committed to using our tools to do everything we can to achieve that outcome.
Well, economists every day were asked to put a probability on the soft landing. I try very artfully to avoid it, and I'll just put it as I have high hopes. So the unemployment rate, though, has risen. And so should folks be focused more on the delta, the change in the unemployment rate from that very low 3.4, 3.5 to now 4.2, or the fact that 4.2 is only 0.2 above where the committee believes full employment to be, if we can have any confidence of where we think full employment is? And how would parsing demand versus supply in that rise in the unemployment rate factor in?
I mean, the change that we've experienced in the unemployment rate is information, and we shouldn't reject that for what it's worth. It's information. We should know it and consider it. And is it telling us something about future movements in that direction? We can't know that, but that's the question. So we're not going to ignore that. I think also the level of and the reason why unemployment has moved up too is also important. But the level is still a level that is, I remember when I joined the Fed in 2012, I remember unemployment going down below 6 and then down below 5, and people were really thinking, wow, we're in the 4s, this is really low. 4.9% was considered to be perhaps below the natural rate. Now we're talking about 4.2. So I think you need to keep that in context. In terms of supply and demand, it's really down to the level of payroll job creation has come down pretty significantly from where it was earlier this year and certainly in prior years. It's 116,000 a month for the last 3 months, and that's without the QCEW adjustment, which would tend to suggest that that'll be revised down significantly in time if the QCEW adjustment is sending an accurate signal about what's happening now.
Those are the preliminary annual benchmark revisions.
Yes, through March.
Right.
That's right. So, I think you look at all of it, you've got a solid labor market, and, we are recalibrating our policy stance, and we'll continue to do so going forward in order to maintain that position.
And when you talk about following the totality of the data, obviously in the US we enjoy really a good deal amount more of government sources than I think other countries. We have a lot of private sources for data. And so this is a shameless plug for NABE really, because I wouldn't be president without it, but Sonia Goodell, who is the chief economist of Indeed, is a member, a valuable member. And Indeed, LinkedIn, ADP, they all put great monthly reports out on the dynamics of the labor market from millions of data points, really, that they track. How do you take into account, sort of say, a JOLTS, which is an official government source for the flows in and out of the labor market, versus what some of the private sources show? How closely do your economists follow that?
Oh, really closely. Yeah. Of course, we look at JOLTS, we look at Indeed. You can pick out any of these and critique it, but I think the bigger picture is that the business of collecting data about the U.S. economy and analyzing it is really one of the great achievements of our country, frankly. We're committed to doing everything science allows us to do to understand what's going on in the economy. Understanding it perfectly is impossible, but we do everything, we do some of this at the Fed, mostly this is not done at the Fed, but the collection of data and the information that we get are as good as it can possibly be. And basically, it's a great success story about our country and about our economy, I think, overall.
Yeah. Maybe another shameless plug is just that NABE is a very strong supporter of funding data agencies at the government level to ensure healthy, reliable, and sound data sets. Just saying. So given that you're talking to a room full of economists, I'd love to get a sense of how you all at the Fed use your economists. You have just a few at the Fed. I think 150 or so, I'm not sure, but it's a lot. And maybe, when you're in the committee meeting itself, how do you use the economists to give you updates, to give you the data that you need to help you make decisions?
We have a lot more than 150 economists.
Okay. I knew it was a big number.
It's a big number, but
Are you hiring?
It's
for the NABE scholars.
We're always hiring, always. We're an interesting organization, and we have very large number of PhD economists, but we also have policy-making responsibilities in monetary policy, in payments, in financial regulation, and so we're kind of on the line between academics and policymaking, very important policymaking. The economists that we have, I would say this about the other professionals that we have, they're incredibly important to the work that we do. The way I experience it is I meet regularly with different groups of economists, but if I have a question about something, often about the labor market or inflation or anything, I'll get an answer, but usually I get a group of people. And these will turn out to be people who have spent, 30 years or 20 years, thinking about that very question. And there might be 2 or 3 different opinions or way to approach that problem in the room. So people, they feel free to disagree with each other. And they also feel free to disagree with us, with the policymakers. And we feel free to disagree with them. I mean, it's a very healthy dynamic. But, these are, so many of these people. They're wonderful people. They're incredibly committed public servants. I'm deeply honored to get to work with these people, and I think I think the Fed is a great place to work for an economist. One of them said to me, one of the most senior ones said, if all we could do around here was just sit around and analyze and talk about the economy, we'd have the best jobs in the world. All the policy making is hard, but ultimately it's really fun and enjoyable to analyze and discuss the economy. We could all spend our whole lives doing that. But we have other responsibilities too.
No, just a few.
You can probably relate to that.
Yeah. Well, I think even you and I have a conversation where you said, I like nerding out with the economists, and we appreciate that. Yeah. I'm glad that you do.
I speak economies.
You speak economist, yeah. It's a whole different language. So in our last minutes here, sandwiched between you and Alon Collette at the lunch table, lots of talk around, I hear guitars, I hear blues music, I hear comparing every band that's your favorite and albums, and I feel like that's been the conversation of this whole conference. As Alon said, we were at the Johnny Cash Museum last night. Nashville is just a phenomenal place. And so if you were to be able to stay over, what would you do this evening in Nashville?
I would certainly visit the Patsy Cline Museum and the Johnny Cash Museum. Big Patsy Cline fan. I like this kind of music. I like music way too much. The other thing is there's a band that it turns out Alon's going to see tonight, called the Time Jumpers, and it's basically the best studio musicians in Nashville and hence in the world, really, in the kind of music they play. And they play at a place called Third and something or other. Third and Lindsley, but it's an excellent band. Vince Gill sits in as the lead singer, but he's not always there. Anyway, that's what I would do. And I've got to come back because I've been a fan of that band for 10 or 15 years and I've never seen them live. So.
Well, in about 15 minutes, it's going to be sold out. So.
I've got some tickets.
Yeah. Well, yeah.
Sold out.
Already is sold out. Oh, gosh. Okay. Should have known. All right. Well, next time then. And for now, thank you so much for giving us your time today, Chair Powell. We really appreciate it.
Thank you. Thanks, Ellen.
All right, guys, so that is Powell. Today, we're going to try to trade a little bit more. Like, here's Bitcoin right here. Market originally reacted really, really negatively to this report, and then somehow basically just came all the way right back up here. So now, you know, the market's basically right where it started. Look at this big downward move on the SPY, and it literally went right back up. Again, as I said, a restrictive Powell. Like again, Powell is very balanced. You know, like these things are not like, if you hear me talk about these Fed meetings, it's really frustrating because like everybody wants to be, human nature trends towards the exciting, right? Like, so bias trends towards the exciting, right? But everything's not always exciting, right? So like if we're here betting on what the next Fed decision is going to be, it's really exciting to bet something that is super low probability that might shock markets and go crazy. And for whatever reason, you get a bunch of freaking people in the chat do the same thing. They're like, oh, we're going to cut rates 2 months early or some crazy stuff that's just never going to freaking happen. Or we're going to raise rates, some stuff that's just never going to freaking happen. And that's human nature to a certain extent, to want to be contrarian. Again, Powell, the Fed, economic decisions, rate decisions are balanced. And so it's very easy. We cut rates 50 basis points last meeting. What do you think Powell's going to say today? Do you think Powell's going to be dovish again? No, he's going to be balanced. He's going to be hawkish during this report. It's pretty easy to predict, guys. I hope you guys understand that. It's just very easy to predict. You know, we'll try to get some trades in. Like I said, we got funded today on one of our funded accounts, or on a Top Step X accounts. So we actually got funded today on one of our Top Step accounts. And it feels good, man. It feels good. Again, I don't know what the market's going to do. I think I'm going to short a little bit up here. I'm going to switch to my actual funded account, and we're going to start shorting this move here. So we have, again, we've got 2 contracts live. And the good thing about Top Step X is that I can actually day trade micro contracts. So like, look, we're up 20 bucks. I'm going to take half off, lock it in. We're up another 20 bucks. We just locked in about $30 in profit. And what was that, like 5 seconds? And again, this is the beautiful thing, is that I can take these small little trades. Look, 74 cents in fees on Top Step X. Genuinely a powerful thing. And again, if you want to check out one of my sponsors, the only one I have right now is Top Step. Great way to help support the channel. Again, there's no PDT rule in futures. You can day trade short the futures market, basically get very similar action to day trading stocks. No PDT rule. Top Step X is the biggest edge in funding. They give you a demo. Test your skill with it. If you pass the test, they fund you. The base one's only 49 bucks. With that, if you pass that challenge, you get 50K in funding, 90% split. They've paid out over 40 million. If you fail, which is most day traders will fail this because most day traders lose. I don't care who you are. I get it. People think they're going to be some prodigy savant and just ride off into the sunset. Everybody's going to be like, dang, look at Bill. Bill can freaking day trade. What a genius. That's not going to be you. I'm here to tell you that's not going to be you. Okay, you're probably just going to lose money. And so limit your risk. Try a funded account program. Like, don't risk $5,000 of your own money trying to day trade stocks just because you want to look like some whiz kid. Okay, almost all day traders lose, right? And then they end up lying about it and pretending and like all this stuff. Like, look, just try a funded account program. If you lose, you're out 50 bucks. It's not the end of the world, right? That way, it's a lot cheaper than losing 5K. You know, I hope that makes sense. Understand, guys, I do trade off stream. You're not going to see all my trades. I'm not even claiming to be a good trader. I'm definitely one of the top 3 worst traders ever in the world right now. So don't copy me. I am not an investment professional. Understand CFTC 4.41 hypothetical or simulated performance have limitations, guys. Don't sue me. Is all I'm saying. Again, it's not going to work. Like I disclaim everything, and so understand that. Yeah, I think he had a hawkish tone. What book do you suggest read to upgrade my knowledge on the economy? What I would do if you want to upgrade your knowledge on the economy. Okay, this is what I would do. Y'all want to know what I'd really do, genuinely do? This is what I would do. Okay, stick around. listen. Okay, just listen to what I'm about to say. All right. Go to Barnes and Noble. This is what I do. Y'all want to know what I do? I'm going to tell you what I do. Okay. Go to Barnes and Noble. Okay. Find every economic book that looks interesting to you. All right. Find every economic book that looks interesting to you. All right. So I'm going to give you a quick example. I went over this earlier in my live stream. First of all, like Basic Economics by Thomas Sowell. All right. That's number one. So we're going to just use that as an example. All right. Like, look, you go to AI. You know, you can get ChatGPT completely free. Okay, you go to AI. Again, if you want to check out Top Step, I think I put the link up. Did I? Yeah, I did. Okay, cool. You say, summarize the first chapter of Basic Economics book by Thomas Sowell. Okay, in what, 300 words? All right, this is what you do. Okay, you take pictures of the books. You find books you're interested in, you snap a picture of it with your phone. Okay, and you do this with every chapter. Okay, in the first chapter of Basic Economics, the author introduces economics as a study of the use of scarce resources which have alternative uses. It emphasizes the fundamental economic problem is scarcity, meaning there are not enough resources to satisfy all human desires, you know, blah, 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 right? You do that for every freaking chapter, and you've read a very, very good economics book in about 30 minutes. Okay, and again, it's easier to understand. There's less fluff. You can basically get all the main points without spending hours reading. Okay, it's going to save you time. Do that with 3 or 4 books on economics, and you'll have a pretty good understanding of economics. If you dedicate the time to it, you'll have a pretty good understanding of economics, like really, really fast. Okay, again, people get mad at AI. This is how you use it to digest things. It's much better. Yeah. So, do it now. You know, that's what you do. There's a lot of it. There's economic facts and fallacies. There's a lot of good books. You know, Thomas Sowell. You don't know who Thomas Sowell is? Again, it's just economics. Like, we're just talking about, like, this is what you do. Okay? Like, that's how you learn. Just study economics at a top university. I mean, you could, sure. All right, we're going to start shorting this again. We're going to take 3 contracts out the gate here, take half off there. Try to wait till we get a larger breakdown, take another half off there. Wait till we get another larger breakdown if we get it. Take the rest off there. That's another, what, we just made, what, like $50 in 5 minutes? Not too bad. We'll keep grinding this up. We also, again, got actually funded on our other account today, so, you know. But yeah. You're welcome, guys. Again, guys, listen. Tomorrow, we got the JOLTS job opening report. Tomorrow. That's actually a pretty big report. It's not small. It's definitely not small. We got the JOLTS job opening report. Yep, there's some jokes. Get out. Listen, get your mind out the gutter, guys. We got some big reports tomorrow. Okay, we have the JOLTS job opening report. It's at 7.64 million is what they're expecting for job openings. And we also, at the same exact time that JOLTS drops at 10 a.m. Eastern Standard Time tomorrow, we have ISM manufacturing PMI data. Okay. And so these are very important reports. You want to pay attention to them. The JOLTS report tomorrow at 10 o'clock is the biggest report of the day tomorrow. Wednesday, we have non-prelim payroll data. We got Tesla delivery numbers dropping Wednesday. So if you like Tesla stock or whatever, you follow it, you want to watch how it influences the market, we'll cover the Tesla delivery numbers right here live on Wednesday. We also have ADP non-farm employment numbers coming out 8:15 a.m. Eastern Standard Time on Wednesday. Again, if you haven't subscribed to my channel, we cover all this stuff completely free. We don't sell a course, don't sell a service. I don't even claim to be good. Don't copy me. Not an investment professional. Not liable if you lose money. But if you want somebody that's going to cover all of these reports as fast as they drop, as soon as they drop, faster than everybody else, really subscribe. You know you want to. Thanks for the excellent news coverage. We try over here. Really, it was in the early 90s. So Jolt. Oh, no, was it Surge? Was it Jolt or Surge? I'm thinking of Surge. I was a 90s kid. So I'm thinking of Surge. You know, young folks nowadays, they don't understand. Surge. You know, some of you guys know. Others don't even know. Surge. Banned. How much caffeine did Surge have? I really got to look this up. Caffeine only had 51 milligrams of caffeine, or Surge only had 51. That's pretty light relative to a lot of the modern age stuff here. So, you know, it's not, it could be worse, I guess. I was thinking it would have like 200 or something crazy, but nope, not that bad. Four Loco, yeah, I remember that. Jolts haven't come out. Oh, Jolt, I'm sure was stronger. Again, when Jolt was live, I was just a little pup. You know, I wasn't out there when Jolt was, you know, thriving, living life. So yeah, again, market's basically completely flat from Powell. It went down really big when Powell was pessimistic. It went up really big whenever he was less pessimistic, and now we're basically just sideways. We're right where we were before all of it, and so could have been worse today. Again, the JOLTS report, we got a lot of stuff. Every single day this week, we got stuff going on. Tomorrow, we got the JOLTS job opening report at 10 a.m., ISM manufacturing PMI at 10 a.m. It's a big day. It's a big report. You want to pay attention to it. Wednesday, we have Tesla delivery numbers dropping. I think it's around 9 a.m. is usually when Tesla delivery numbers drop. So we're going to cover that. We also have prelim payroll numbers preparing us for Friday. Thursday, we got jobless claims, unemployment filings coming out. We also have services PMI, factory orders, ISM services PMI at 10 on Friday. A bunch of Fed speakers on Thursday. I mean, Thursday is what I'm speaking on, not Friday. And then Friday is the biggest day of the week in terms of economic reports outside of today. Because on Friday, we have non-farm payrolls and unemployment. Now, if you heard what Powell said at the beginning of this speech, there's something to talk about. One of the things that Powell said in his prepared remarks, which means that it was premeditated. He wrote it down, and then he read from whatever he wrote down. One of the things he said was that unemployment was well below our expectations. You know, now the question you have to ask yourself, is he referencing last month's unemployment, or is he going to be talking about the next one that drops this Friday? Did he give us a little clue about what unemployment shows up as on Friday? Because again, Friday, we have the actual unemployment percentage coming out. Thursday, we got jobless claims unemployment filing, so maybe that'll have some influence, or maybe there's going to be some clue there. But I think Friday's number is the percentage, unemployment percentage. And so maybe he gave us a little clue. I don't know. The expectation for unemployment on Friday is 4.2%, so they haven't revised it at all. But, you know, maybe it's, again, I don't know what it's going to show up as. Yeah, I heard about the port stuff going on. Yeah. 250K since 2020. Dude, scale down your size, Destiny. Like, listen, the biggest mistake traders make is that, like, listen, again, it's partly due to marketing. Okay, like, oh, look at you. You could be rich. Spend $1,000 and you can turn it into 20K right now in 3 weeks using my trading system. It's nonsense. It's total nonsense. It's all crap. It's not true. I mean, you could, just like I could walk out and, you know, buy 5 lottery tickets and win the lottery 5 times every day. You know, it's possible, but it's not probable. It's not likely. You know, same thing with turning $1,000 into 20K. Like, sure, you could do it, but are you going to do it? Probably not. You know, it's just super outside the realm of probabilities here. And so again, the problem is marketing. But listen, when you're first getting started trading, if you're losing money, if you haven't made profitable years trading, do not trade large. Trade small. Wait until you have, like, everybody wants to look cool, but the reality is, you know what's cool? Not losing money. And so trade small. Don't take big size. Almost all day traders lose money. And so it doesn't make any sense to trade large and just try and, you know, like, it's hard to explain, but almost all day traders lose. And so just scale down your size. Trade small. Make $10, $20, $30 a day if you can. Once you do that, then scale up your size a little bit more. Make $50, $60, $70 a day. Then scale up more. Make $100 a day, so forth and so on. Have a scaling plan here. Like, have a plan where you scale up your size slowly. Because if you're not, you're just going to lose a bunch of money really quickly. And that's most people, to be honest. And so, again, I'm trying to help you guys. I hope that makes sense. Again, try Top Step if you want to limit your size that way. That's a great way to do it. But just trade small. Anyways, guys, I'm going to get out of here. Again, y'all be good. Y'all have a great day. I'll see you guys a little bit later. Y'all be good. Love you all. Again, understand, not an investment professional. I'm not liable if you lose. Always make your own assessment. Trade responsibly. I have no idea what I'm possibly talking about. Do not copy me. Not an investment professional. I'll see you guys later.